Hey everyone, welcome to QuantSreet's News and Analysis Podcast. This is your host Mahir welcoming you to the latest episode of QuantStreet. Good morning, good afternoon, good evening from wherever you are listening. Today is Wednesday, September 2nd, and here are the major economic updates for today. First is a story from NPR by Scott Horsley. US to owe more than the size of its economy for the first time in 75 years. The pandemic is taking a big toll on the government's bottom line. The federal government accumulated debt burden is projected to be larger than the overall economy next year for the first time since 1946. Debt is expected to reach an all-time high of 107% of gross domestic product in 2023. The nonpartisan Congressional Budget Office expects the deficit to reach $3.3 trillion in the fiscal year ending this month. That's about 16% of the GDP, a level not seen since the end of World War II in 1945. Federal spending has soared to 32% of GDP this fiscal year as the government tries to address both the economic and public health costs of the pandemic. The coronavirus has infected more than 6 million people in the United States and has claimed more than 180,000 lives. With tens of millions of people out of work and countless businesses struggling or shuttered, tax revenues are falling. Revenues are projected to be 16% of GDP this fiscal year, down from 16.3% last year and 18% in 2015. The Congressional Budget Office projects that both revenues and spending will decline in the upcoming fiscal year, which begins October 1st. Next year's deficit is expected to be 8.6% of GDP. Despite the historically high debt levels, the government's borrowing costs are expected to remain low for the next several years. The Congressional Budget Office projects interest costs will decline through 2024 before turning upward in the latter half of the decade. Moving on to the next story, which is a Fed's mortgage buying spree at $1 trillion with no end in sight by Christopher Meloni at Bloomberg. The Federal Reserve has snapped up $1 trillion of mortgage bonds since March, a record pace of purchasing as the US Central Bank tries to blunt the impact of COVID-19 recession on American home owners. The Fed bought around $300 billion of bonds in each of March and April, and since then has been buying about $100 billion a month. It now owns almost a third of bonds backed by home loans in the US. Buying the securities has pushed mortgage rates lower, with the average 30-year rate falling to 2.9% as last week from 3.3% in early February. That drop has allowed homeowners to refinance their mortgages, tantamount to giving them a raise by cutting their monthly loan payments. It's also helped consumers buy homes. But the Fed's efforts are causing its balance sheet to balloon, and with the central bank owning so many US home loans, it has unusually high power over setting mortgage rates. The Fed's purchase efforts started off with a bang on March 15, when it said it was slashing its benchmark interest rate back to 0% and would purchase at least $200 billion of mortgage-backed securities. On March 23rd, the central bank signaled its willingness to buy near unlimited amounts of debt, changing at least in its statement to in the amounts needed. By the end of that month, mortgage purchases totaled $291 billion, an average of $23.4 billion per day. While the Fed has been buying mortgage bonds, it's bought even more Treasury securities, around $1.8 trillion since mid-March, according to data from New York Fed. The central bank's purchases has expanded its balance sheet to $7 trillion from $4.7 trillion on March 18th. Morgan Stanley analysts pointed out in late March that the mortgage buying was running at 8 times the pace seen in prior episodes of Fed purchasing under programs known as quantitative easing, a pace that has since slowed. The current monthly rate of about $100 billion translates to about $40 billion net after accounting for borrowers' principal repayments from the mortgage bonds already on the Fed's balance sheet. The last statement from Fed has promised to keep buying at least at the current pace. If the central bank does so by the year's end, it will have purchased about $1.4 trillion in mortgage bonds and added around $900 billion net to its holdings. That purchasing will fuel the growth of the mortgage-backed securities market, which finances the majority of the roughly $11 trillion of the US single-family home loans outstanding. Back in December, consensus was for net supply to come in around $265 billion this year, a level that would be right in line with the annual average of $270 billion over the last half decade. JP Morgan Chase and Company analysts last month raised their forecast to $390 billion, which would be the highest since 2009. According to JP Morgan analysts, the increased size of the market makes the Fed's pace of buying sustainable. Between September 2012 and October 2014, during a quantitative easing program known as QE3, the Fed owned a record 34% of the market. Just before this latest round, principal payments from its mortgage bond holdings had whittled that down to 21%, but it has now increased back to 30%. If the Fed maintains its current buying pace, it will again own 34% of mortgage universe by year's end, the analysts added. Supporting economy, the Fed's purchase activity has allowed risk premiums or spreads on mortgage bonds to remain little changed now compared with the end of last year. It has also helped improve mortgage bonds returns for the year compared with performance in the first few months of 2020. The Bloomberg Barclays US MBS index has bounced back to minus 0.34% as of Friday's close from a year to date low of minus 2.87% on March 19th. Buying so many home loans is the right thing for the central bank to do to support the economy, Kevin Jackson, a managing director of the mortgage trading desk at Wells Fargo and Company, said in an interview with Bloomberg. We had a pandemic arise and you needed a force to come into the market and stabilize things, Jackson said. And with that, we come to an end of this episode. This has been your QuantStreet news and analysis briefing. Check back on this channel for more such stories. And thanks again for listening. If you enjoyed the thoughts on the economy, please take a moment to rate and review us on the podcast app of your choice or YouTube and help more people find the show. The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.